Hello everyone and welcome to the class of Principles of Microeconomics, Econ 111, lecture number 17, and this lecture is about the cost of production. In this lecture we are going to understand the cost of production, and in order to do so we are going to review our earlier concepts about the supply and demand. These are the two forces that determines the equilibrium in the market, the equilibrium prices and the equilibrium quantity. And we have already seen that how it is done. We have two-dimensional graph where we have prices on the y-axis and quantities on the x-axis, and the supply curve and demand curve determines the overall prices in the market, that is the PM, the market price, and the QM, the market quantity. Now demand is basically the consumption side, how the consumer behave, and the consumption is determined by the basic principle that an individual is a utility maximizer. An individual wants to maximize his utility. But when we come to the supply side, this is entirely related to the production, and for the production purposes, there are two important things. One is called the revenue, the other is called cost. And in this chapter, we are going to cover the cost. How is cost determined? What are the various types of cost? And how it increases or decreases the overall profitability of a firm. So what are costs? According to the law of supply, firms are willing to produce and sell a greater quantity of good when the prices of the good is high. We know that whenever we raises the price in an economy, in a specific market, the overall supply curve that will increase, right? On the lower prices, firms will supply lesser quantity. On higher prices, firms are willing to supply more and more quantity. So because of this fact, because of this law, the law of supply, it determines the slope of the supply curve, that is an upward supply curve. And the objective of firm is to maximize its profit, right? As the objective of a consumer is to maximize his utility, the objective of a typical firm is to maximize its profit. And how is the profit determined? Basically, we have uh, for profit purpose, we define profit as revenue minus cost. And let me do that in the subsequent slide. We have total revenue, and total revenue is defined as the amount a firm receives from the sale of its output. Students usually confuse the two terms. They usually confuse the revenue with profit. Profit is something else. For students who are studying accounting and finance, the total revenue is usually the income from the sales, right? And then we subtract the cost of goods sold from it, and all the expenses, and ultimately we get the profit. So revenue is basically all the inflow that a firm is receiving, rather than we are subtracting anything out of it. Then we have the total cost, and the total cost is the market value of the inputs a firm uses in its production. What is the market value of inputs? Basically, there are a lot of inputs used. First and foremost, that is the raw material that is required for the production. And secondly, we have the input in the form of capital and labor. So the amount of capital that we are hiring and the amount of labor that we are utilizing for the production, that is that we pay them something, because neither capital is free nor labor is free. We pay a rent to the capital, and we pay a wage to the labor. So basically, if we um, write it in short form, that is rent plus wages paid by the firm. and it also includes maybe it also includes the uh, cost of the input, the raw materials. If we are talking about raw materials in general, it includes them as well. Then profit, the firm's profit is the total revenue minus the total cost. So two variables that we have already discussed, that is the revenue minus the cost, and this gives us profit. And again, in accounting and finance terminology, we may call it the net profit, net income of a firm after subtracting all the costs that are incurred in the production for the firm. So in mathematical form, we can write it as profit, which is equal to total revenue minus total cost. Now we will also define, we can define total revenue as simply the price of the specific good multiplied by the quantity sold of that good. So defining revenue is very easy, but uh, there are a lot of concepts relating to total cost, and total cost, we will discuss these small details of the total cost in this lecture. So one of the form that we were talking about the total cost, that is a firm's cost of production, that includes all the opportunity cost of making its output of the goods and services. So it includes all the entire opportunity cost. And again, the entire opportunity cost consists of two types of cost. One is that is paid in the form of cash, and the other that is not paid in the form of cash, right? So let us discuss them as well. These two costs are known as explicit cost and implicit cost. What are these explicit and implicit costs? Let us study them as well. A firm's cost of production includes both these costs, and the explicit costs, they are defined as the input cost that requires a direct outlay of money. This is important. It includes a direct outlay of money. So this includes cash. Explicit cost includes money, whereas on the other hand, the implicit cost that does not require any outlay of money by the firm. You need to understand this carefully. The total cost, that is the opportunity cost, right? It includes the explicit costs that are paid in the form of money, and implicit cost that does not require any money paid. That is exactly like the concept of opportunity cost that we understand. Let's say that there is a firm which is producing a firm that is producing, let's say they're producing laptops, and for laptops they require input material, and they are paying for those inputs. They are paying, they are also paying the wages, they are also paying the rents. Sorry. So all these amounts, they are included in the explicit cost. But what if instead of producing laptops, the firm produce TV screens, and for the production of TV screen they might have used these same resources and earned something differently. So that is the implicit cost, that is not directly counted as cash, but an opportunity cost. Even the cost of the entrepreneur himself, that is an implicit cost, because he is not paying wages to himself. But what if he utilized his time somewhere else? He could have earned a salary, and that amount of salary which he has sacrificed, that is included in the implicit cost. So because of the concept of the explicit cost and the implicit cost, there is a difference between the economic profit and the accounting profit. A simple accounting profit that we see in routine is that they see how much inflow has occurred to the company, the cash inflow, and that we call the revenue, and they subtract the explicit cost out of it, so they get an accounting profit. But whereas the economic profit, that includes explicit cost plus the implicit cost, and accounting profit does not include any implicit cost. So economists measure the firm's economic profit as a total revenue minus total cost, and this total cost includes the explicit cost as well as the implicit cost. An accountant measures the accounting profit, the net income that we usually talk about. The net income is calculated as the total revenue minus the firm's total explicit cost. So accountant does not count the implicit cost, whereas an economist always counts the implicit cost, and that does makes a difference. Why is it important? Let's say that there is a businessman who earns a revenue of, let's say, 1000 rs 1000, and he's paying a cost and in the form of electricity bills and wages and rents, etc., equivalent to 800. So his profit is simply 1000 minus 800, and that equals to 200. So he is basically earning 200. At the same time, he was also offered a job which paid him, the job paid him Rs 400. So the implicit cost now for this person is 400. You can also see that he is earning 200 from this business, and he could earn 400 from doing a job somewhere else. So which option is best for him? Obviously, if he worked somewhere else, that opportunity that was much better than he's doing the business here. He's in the firm, in the he's as an entrepreneur earning less than he could earn by doing that job. So we include this 400 cost as implicit cost in our calculation, and Rs 1000 is his revenue. The explicit cost that he's paying is 800, and the implicit cost that he is not doing their job is 400. Now 1000 minus 800 minus 400, this gives us minus 200. So according to economists, he is actually losing 200, but according to accountant, he is earning 200, right? But this 200 is not good enough for him, so he should not be in the production business. He should not produce laptops. Instead, he should work in the job that was being offered to him. This is the basic idea of the implicit and explicit cost. So when the total revenue exceeds both explicit and implicit cost, then the firm earns economic profit. When revenue is greater than explicit cost, let me revise that. When revenue is greater than explicit cost plus implicit cost, then the firm is earning profit. The firm is in profit and will continue its business. Otherwise, If the profit, if the revenue is less than explicit cost plus implicit cost, in that case the firm is making losses. So this is the basic concept. Economic profit is always smaller than accounting profit. And why is that so? Because economic profit always includes implicit cost, whereas the accounting profit does not count the implicit cost. So the cost for economists is always higher. So we can compare the two graphically as well. How an economist view a firm and how an accountant view the firm. Both are significantly different from each other. Let's see that we have the explicit cost that an accountant is facing while he is calculating the profit for a firm, and then there is the accounting profit. This is the total revenue. See, so from the total revenue a firm does is subtracts the explicit cost, this total revenue minus this cost, and what we get is the accounting profit. So the profit is calculated in this manner. Or let's say that if you are an accountant and you are creating an income statement, in the income statement the first thing that you will put there is the sales, and sales is basically the revenue, then minus cost of goods sold, and you are left with gross profit. And what you do then is remove the other types of cost from it, that is uh, the interest payments and all identical payments such as taxes. And when you subtract all of them, what you are left with in the end is the net income. And basically this is the accounting profit. The net income is the accounting profit. So you see, an accountant does not include any type of implicit cost in there, whereas an economist will consider the implicit cost. The explicit costs are identical in both cases. Both count these costs, the cost of goods sold, the interest payments, the taxes. They are identically calculated, but the difference is of the implicit cost, and that is what I explained in the example. The opportunity that the owner has missed, if he was doing a job rather than being an entrepreneur of this firm. So this is the opportunity that he missed, and accountant does not count these implicit costs. They consider them as profit, but these are not profit. These are actually costs that he and these costs cannot be a part of profit basically. So the total economic profit is always less. Than you can compare the blue boxes in both the figures. Here the blue box is smaller because the accountant has already subtracted the implicit cost from this total revenue as well. So the conclusion here is accounting economic profit will always be less than the accounting profit, and it is always the economic profit that decides whether a firm should be doing a business or not. If accounting profit is positive but economic profit is not positive, it is actually an economic loss occurring, then the firm will not continue its business. It will stop even though an accountant will see that there is a profit. The firm still uh, will stop performing, and the entrepreneur will go and do the job rather than be at such types of firms. So hope you have understood the basic differences between the implicit cost, the explicit cost, and the role of the opportunity cost. In the subsequent classes, we are also going to study other types of cost, that is the average cost and the total cost and their comparisons. And we will also study the variable cost versus fixed cost. There are a lot of concepts involved in the calculation of cost. So thank you very much for watching this video. If you have any questions, please do ask in the comment section.